Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring you the most important stories that move the markets. I am your host Anurag Bansal, and in today's episode we'll talk about 5 big stories. We'll start by talking about how RBI is imposing stricter rules on banks when it comes to their liquidity. Second, we'll talk about a new rule that has come into existence after the budget, where investors have to pay tax on their exits from startups when it IPOs. In the third story, we'll talk about some good news with Paytm. Fourth, we'll talk about the US GDP's latest numbers. And finally, in the fifth story, we'll talk about how crypto is becoming more and more legal in the US and also probably across the world. So let's begin. See, the Reserve Bank of India or RBI is proposing new liquidity rules for banks, and it is all because of the rise of digital banking. First, why is the RBI even doing this? Look, with everyone using online and mobile banking nowadays, the RBI wants to basically ensure that banks have enough cash to meet any sudden withdrawal demands. Essentially, they are trying to manage all the new risks that can come with convenience and the speed of digital banking that were not there in the older processes. Now, here are some of the changes that the RBI is proposing. First, banks now need to set aside more funds for deposits that can be accessed through internet and mobile banking. The RBI is suggesting keeping an additional 5% more cash aside for standard deposits, 10% more cash for stable retail deposits, which by the way are the ones less likely to be suddenly withdrawn, and 15% more cash for less stable deposits. Second, the RBI wants banks to treat unsecured wholesale funding from small businesses the same way as they treat retail deposits. Now, this means that banks will need to keep more cash or liquid assets available in order to cover any sudden potential withdrawals that these small businesses could make. Third, the RBI wants banks to be more conservative when valuing the government securities that they hold in the form of high quality liquid assets or HQLAs. Now I know that sounds very complex, so let me simplify it for you. See, banks hold government securities as part of their HQLAs because these securities are considered safer and they can easily be sold for cash if required. Now currently banks value these securities at their market price, but RBI is now proposing a change in this. They are saying that banks can still use the same current market price of these securities, but they will have to slightly reduce this value now. But why is this happening, you might be wondering? Look, banking has really evolved and transformed over the last few years. This has allowed people to transfer and withdraw money absolutely instantly. Today, a large chunk of retail deposits have digital facilities. Now, considering the scale, new rules and security provisions are definitely needed. A classic example of what could happen if things are not checked is the Silicon Valley Bank collapse in March 2023. See, Silicon Valley could not handle it when many depositors suddenly decided to withdraw $42 billion in just one day. A good part of this was because of the speed and convenience which online banking brings. Now, the RBI basically does not want this to happen in India, and that is why they're imposing these kind of rules. But while these rules are on a positive note, they could also make life a little tougher for banks. I'll explain. See, first, banks will now need to hold more government securities to meet their liquidity demands. Second, banks will need to maintain more high quality liquid assets, and as per an ICRA estimate, banks may have to hold an additional 4 lakh crore worth of deposits in safer assets. Now this could really hurt the profits that banks could make. They're already struggling with tight margins because of competition from stocks, mutual funds and other players, and now this new RBI rule could just worsen things for them. So if you're wondering what will happen to Indian banks after this change, see, Indian banks will have to compete for stable deposits, which means they will probably have lower deposit growth and by extension lower credit growth as well. So banks will basically have better balance sheets with lower liquidity. Moving on to the second story for the day, let's talk about how investors might have to pay more tax when they cash in on an IPO. See, for the past 4 years, the IPO market has been red hot. Companies have taken advantage of the bull market to go public. In the last 4 financial years, companies that have IPO'd have raised over 2 lakh crore rupees. Out of this, more than 40,000 crore rupees went to private equity and venture capital folks who had invested in these companies long time ago. Now, when PE and VC investors invest into startups, they have 2 ways to practically make money. First is to either sell their stake to someone else, and the second is to hope that the company they invested in will go for an IPO someday. Now, when an IPO happens, they can sell their shares which they hold through something called an offer for sale or an OFS. Now, this was all great, right? But just when PE and VC folks were happy because they got a chance to exit their investments in IPOs, they have been hit with some really bad news in the recently announced budget. Look, until recently when PE and VCs sold their stakes through OFS, they were not really paying any taxes on the profits they make. This is because the regulations were not really very clear on whether or not they had to do this. Many promoters and investors claimed zero capital gains tax and argued that there was no clear rule on calculating these gains. But this will not happen anymore. The government plugged this loophole in this budget. And not only did it close the loophole, but it also made the change retroactively applicable. In simple words, it means that PE and VC investors have to now pay taxes on all the money that they have gotten through OFS sales in the past as well. Now, if you've been around the markets for a while now, you might remember the retrospective taxation nightmares that Vodafone and a few other companies had to face a few years back. The government of India made the move of asking companies to pay taxes on past acquisitions, and that is a strange move because it sends the wrong signal to foreign investors that the government can do anything at any time possible. In the third story for the day, there is some good news if you are a Paytm investor. See, I'm sure you've already read about Paytm's recent struggles. A lot has happened with the company in the last few months. The RBI held back Paytm Payment Services' application to become a payment aggregator. They were barred from onboarding new online merchants in 2022, and Paytm Payments Bank was ordered by the RBI to stop accepting deposits into accounts or their digital wallet. Now, but finally, there is some good news here. The government has approved Paytm's proposal to accept foreign investments for their payment aggregator business. Now, I know this might sound complex to you, but let me simplify things. See, because of this approval by the government, Paytm will now be allowed to invest 50 crore rupees in their payment services, which is a very important business line for them. Now, this approval was stuck for many months earlier because China's Ant Group holds a 9.88% stake in the company Paytm. And the Indian government, as we all know, has been a little careful whenever it comes to Chinese involvements ever since the 2020 border clash. But now, Ant Group is slowly reducing its stake in Paytm, and that has probably made the government a little more comfortable with Paytm as a company. Now, for Paytm, this approval is a very big deal because its payment services business accounts for almost 1/4 of their revenue. And after this approval, Paytm can now also approach the RBI for a payment aggregator license. Of course, the RBI will evaluate this application, but it is still a positive news for the company and all its investors. By the way, if you are unsure what a payment aggregator really does, think of it as a post office. See, just like how a post office collects letters from people and then delivers it to the correct receiver, a payment aggregator does the same thing by collecting payments from the sender and crediting the money to receivers. The news of Paytm being able to invest in this particular business has gotten investors really excited this time. The company's shares immediately jumped by 10% and hit an upper circuit after the news became public. Now, moving on to the fourth story, let's look at US GDP data. See, recently the data for the US economy's Q2 performance was released. Interestingly, this surprised everybody. The growth numbers were much better than what analysts had expected. The GDP growth rate was at 2.8% in Q2, which was double the growth of 1.4% in the previous quarter. Now, this growth comes despite the high interest rates and inflation concerns which we discussed in some of our previous episodes as well. The expectation here was that there would be an economic slowdown, but the exact opposite has happened. So with that out of the way, let me break things down for you and explain this in a little more detail. First, consumer spending, which accounts for about 70% of the US economy, grew by 2.3% in this quarter. This was up from 1.5% in the previous quarter, and it is great news. But on the flip side, US consumers have pretty much spent all the money that they got for free from the government during the pandemic. The other factor that might affect consumer spending is that there are early signs of increasing bad loans on credit cards. In fact, credit card defaults in the US have hit a 12-year high now. Now, it does not mean US consumers are in a bad shape, but all signs point towards a slowdown. Second, companies seem to be now investing into their own businesses. Non-residential fixed income climbed to 5.2% in Q2 from the previous 4.4% in Q1. Now, this simply means that businesses in the US are seeing opportunities that are overpowering the cost of borrowing. Third, with the US economy growing, inflation is also cooling down. But for this quarter, the core personal consumption expenditure index, which is basically a measure of inflation by removing food and energy, came in a little higher than expected. But it is still lower than the peak, so it's not all that bad. Fourth, with inflation getting closer to the Fed's 2% target, there is now chatter that the central bank will ease up interest rates. According to expectations, the first rate cut is expected in September. By the way, the current US interest rates are at a 23-year high. Fifth, all in all, the US Federal Reserve might just nail their soft landing. In simple words, a balance between maintaining growth and keeping inflation under control and not causing a recession is called soft landing. By the way, if you had heard economists last year, most of them would have predicted a recession, but that's not quite what's happening. But that said, there are still a couple of concerns that you should know about. First, there are concerns regarding the job market. The unemployment rate in the US has climbed to 4.1% in June 2024, and that is the highest level it has been at since November 2021. Second, high interest rates are really hurting US consumers, as I already mentioned while talking about consumer spending. Some segments of the population are borrowing money to spend on basic things like food, shelter, and other essentials. Third, if the Fed waits any longer to cut rates, it might miss its soft landing and a recession might not be out of question then. In the last story for the day, let's talk about how crypto is slowly becoming more and more legal in the US and probably across the entire world as well. This year, the Securities Exchange Commission or SEC, or basically the SEBI version of US, approved Bitcoin ETFs and Ethereum ETFs. Now, in many ways, this is a historic move for the US markets as well as the crypto markets because the SEC had been rejecting applications for Bitcoin ETFs since 2013. But why does this matter, you might be wondering? See, one thumb rule is that whatever happens in the US inevitably influences regulations in all other markets, including India. So with that out of the way, let me give you some quick historical context of crypto. See, for about 400 odd years, we've had pretty much the same asset classes: stocks, bonds, real estate, and commodities. Yes, sure, in the last 50 years or so, things like mutual funds, ETFs, etc. have made investing in real estate and gold a little easier. But largely speaking, we haven't really seen any major new asset classes until cryptocurrency came along. See, crypto is probably the first true mainstream asset class to emerge in the last 4 centuries. In just one decade, this asset class has grown to a market cap of about 2.4 trillion US dollars, which is massive. Now, crypto is a strange asset class. It is not backed by anything except people's belief that it will go up. And despite all the hype around crypto, its main use case seems to be speculation. Different countries are handling cryptocurrencies in a very different way. In India, the government and the RBI have made it very costly to trade in crypto by imposing a TDS and asking banks to be really strict. This has led to a 90% drop in crypto volumes from the peak. The US, however, is treating crypto with an even stricter stance. The SEC, which we discussed earlier, which is the US version of SEBI, said that apart from Bitcoin, which is considered a commodity, all other cryptocurrency tokens are securities and don't really need new regulations. They are hesitant to allow crypto to be widely accessible to retail investors, and they have also been suing crypto platforms and imposing heavy fines on them. But recently, the SEC was forced to approve Bitcoin ETFs in January 2024 after they lost a court case. The ETFs have now gathered about $70 billion in just 5 months. But what is interesting is that just a week ago, the SEC approved the Ethereum ETFs as well. And so far, Ethereum ETFs have seen over $3 billion worth of trades. Now, this is big because crypto has never been more legal in the US than it is currently. And it's not only about the US, the European Union and Japan are also bringing in regulations to clear up the crypto confusion. Closer to home in India, however, crypto is neither legal nor illegal. Our regulators don't quite seem to be in the mood to clarify things at the moment, but the RBI has definitely been vocally against crypto. Well, that's all the news I have for you today. I hope you found value in this episode. I'll see you in tomorrow's episode. Take care and goodbye.